Hey guys, so funny enough, I actually had recorded this yesterday and I was going back through and I just tried to watch the videos. This is now the next, a little bit more than 24 hours later, now into the evening, so about 30 hours later than when I shot the first video. It's now Saturday night, or actually Sunday morning. Time goes by quick. Anyways, the last video had no audio captured, so I had a portfolio right at the 10.5K, a little bit over maybe. I'll go back and reference. And I had wanted to capture the moments before crossing past 10K because I was at 10K for some time and I meant to capture this. And then actually I had went in and purchased some shares on Friday. And now that's already past tense. So I may drop in that video, but pretty much I had purchased a share of Lockheed Martin since it was down quite a bit. Looks like it keeps dropping. It's a falling knife. I'm down quite a bit, but I'm just trying to buy down my position. I'm surprised it went down even more actually. And then I got another share of Realty Income, and then I had bought another share of SCHD. So I'm just gonna redo the video pretty much, go through my 10K portfolio now, just crossed into the 11K mark. The market's been down quite a bit, or at least my positions have been coming down quite a bit. Specifically, I say that because I've been putting cash in, and it's like the more cash I put in, like the same or the less the bounce is going down. Funny enough, but that can definitely be a good thing in the long term. You know, once we see some good appreciation on these stocks, assuming they are quality, and I believe that these are quality investments. That's why I've made them. So anyways, enough rambling. Let's go ahead and jump into the portfolio. So starting at the top, I have Lockheed Martin. I have roughly $1,700 in Lockheed Martin, 4 shares. This was a company that I had wanted to get into for quite some time. It was really running up for quite a while, and then I was like, man, looks like I'm missing the boat. FOMO'd in. It's turned out to be bad timing. Lockheed has been on a downward trend since then. But it's a company that I think long-term will still do good. They pay healthy dividends, and I think overall defense is a relatively secured industry. So I'm optimistic on the future of Lockheed, and I think that there's perhaps some political influences on Lockheed at the moment, and those things come and go throughout different administrations, so I'm not worried in the long term, regardless of the short term. Next is Altria Group. So this one is one of the earlier positions that I took in this portfolio. I started this portfolio maybe about 8 months ago. And this was one of the first ones that I got into. It's been a pretty good performer. Altria Group has a high dividend yield. Maybe I'll go ahead and pull in some of these informations. That might make it get in. I like to pull up Robinhood. It's a quick, easy app that I like to just go in and check everything. So the first stock, Lockheed Martin. So we've seen the 1 year, they were really shooting up here in October. Perhaps that's the time I didn't get in there. I think I got in around the 500, 400 mark. No, it's only about that now. So I probably was buying around these prices thinking I was getting in at a good price. Looks like I wasn't. Anyhow, and this is something I bought in the past. I've had different dividend portfolios over the years. This is actually my 3rd dividend portfolio starting up. Hoping to stick with it long term. I've transitioned stocks out in the past. Anyways, so the PE, it's pretty attractive compared to a lot of tech companies. Of course, it's not a tech company, but to me, it's a pretty attractive PE for Lockheed Martin. Dividend yield 3%. That's pretty healthy in my perspective. Anything else they show us here? Doesn't show us the payout ratio. Doesn't show us a couple other useful metrics, but overall, let's see their earnings. They're beating their earnings expectations. So optimistic about Lockheed, especially at these prices. Maybe I might get another share, but really I want to start building it in my ETF exposure because I have a lot of individual stocks. And the reason that I have a lot of individual stocks is because I have been wanting to pretty much just mark my position in these stocks. And then from there, I'll go in and really focus on buying down the cost on the ones that are down and being able to really track it easily within this one app rather than going back and forth. Just, okay, I see Pepsi's down. I'll buy into Pepsi to bring down my yield, bring down my cost basis. And, it's just a more attractive price than what I got into originally. I believe in these companies long term. That's why I have them. So if I bought them at one price, I should be happy to buy them at an even lower price. Anyways, now that I've marked the positions in the companies that I want to get into, I'm going to go ahead and just focus on ETFs to really bring that up in equilibrium to the value that's in individual equities or perhaps greater. Let's see, because my performance has been way better in ETFs than with individual equities. But I think that's, like I mentioned, just because I haven't really been timing it. I've just been wanting to get in to these companies and then I go from there. So I think over time we could see a shift where the individual stocks start to overperform the ETFs, but we'll have to wait and see if that's the case or not. I guess obviously typically the case is that ETFs will outperform. It looks like that's the case so far. All right, continuing on. One other side note, the other company that I'm looking to get into next is American Express. To American Express, the thing with Amex is they're very expensive right now. I have all the other card companies, which you'll see in my portfolio, but Amex is the one that I didn't get into as of yet, and I think it's because the price has always been, I felt, high. But actually the PE is low compared to a company like Amazon, which I was checking out recently. Amazon is a company that I really like, but their PE is very high right now, and I wanted to get it into my portfolio, but I'm not going to buy it in the dividend portfolio because Amazon doesn't pay dividends at this time. So when Amazon does start paying dividends, then definitely I might consider it in my dividend portfolio, but for the time being, I'll just keep that in like retirement portfolios and whatnot. All right, so Amex, actually it looks like it might have come down a little bit from the other day. It's down a bit. It's not looking as expensive as I had thought with considering this PE. Dividend yield, it's low, but they have a high growth rate on that. So yeah, this will be the next company you guys see me getting into. Okay. All right. Altria Group, ASML. This one has seen some gains recently. This is the one that I really like. Let's go how ASML is doing. They're down quite a bit from their all-time highs. ASML. Yeah, so they're up to about 1,000. Now they're down to 730, and I think I got in around the 650, 670 range. To me, this looks like a fair trend point of where they might be considering their growth in their industry, the demand for their products. It looks like analysts have good expectations for it, and it looks like they've been beating their earnings expectations, so I like to see those trends. It's a high PE at the moment, so this makes me even more attracted to want to buy Amex because Amex is paying higher dividend at a lower PE, and Amex is also, to me, in a very great industry. Okay, so continuing onward, we have Apple. Obviously, everybody knows about Apple. It's a company that I definitely want in my portfolio. I think that they'll be growing their dividends and their yield greatly over time. Haven't had as much innovation in the last decade, but I think that those things can quickly turn around. I believe in quality companies, and Apple always puts out quality products, so it doesn't take much for them to put out something innovative. I mean, it does take a lot, but once they do, I'm sure it'll be great, and it could be the next headwind for that company, which will be needed. But I think in the short term, they have a lot of pricing power in their current products and can really drive up profitability and marginal growth for years to come through great management. MasterCard, this is another company that I really like. I like this industry in general. Continuing onward, Lowe's. I go to Lowe's and Home Depot all the time. The cost of homes are always increasing, the cost of repairs, the cost of the products that they sell. I think that Lowe's and Home Depot have a bright future, and I really like these companies. Chevron, some exposure to oil. They pay great dividends. I think that they're down compared to where they've been historically. Let me go back and see. It's been some time since I've checked these charts. So they're trading pretty much flat for a good number of years, and then they've spiked up recently, actually. But Chevron is one of these companies with a lot of opportunities. They're trading at a very low PE. Well, it's an older kind of company. And then they're paying a very high dividend yield, or fairly high. It looks like they are okay with their earnings. Yeah. I like this one because it helps me boost up my portfolio. But it looks like growth could be in the question for Chevron. But through the dividend yield, I feel comfortable holding Chevron, and I think that oil has a bright future. PepsiCo, they're down a lot right now. That's a company that I got more into recently, doubled down on that position. Home Depot, we already talked about. Microsoft, I think Microsoft's one of the best run companies in the world, if not the best well-run company. They have so many income streams. They have so many subscription models. Microsoft's just this really solid company. Really like Microsoft, and it's one that I want to get more into for sure. Visa, like I mentioned, I really like this industry already. Same with MasterCard. I have Discover down here. Discover's been the best performing since I've been holding these, but they're all doing great. And we'll get Amex in there as well and just capture the whole market. Some might say it's overexposure to that market. Maybe that's right. Maybe I'll have to reconsider that in the future, but I really just enjoy holding all those quality companies. I think they're just really all amazing companies. Coca-Cola, everybody knows Coca-Cola, great company, great appreciation, great dividend growth. Salesforce, this is a company that I've actually made really good returns with over the years. That's not going to be reflected in this portfolio. I've sold out of those positions. Actually, I used to work there, so I was able to get shares at somewhat of a discount, and that did pay off handsomely. And Salesforce has really been a really great growth company over the years. And now they're paying dividends, buying back shares, so great addition to the portfolio, and it's really been proving its worth. Philip Morris, another tobacco company with Altria. This one has more international exposure. I like Philip Morris, and I think it has a bright future ahead. Taiwan Semiconductor Manufacturing, great company, some geopolitical risks. I really like this company, though. It's given me decent returns, just one share, but it's one that I want to get more into if prices do come back down. Discover, same as the others. Google, got into this one recently. Want to definitely build up more positions in Google. Really like Google's products. Really like YouTube in particular. I'm a big YouTube watcher, and I guess now participant on this channel. So yeah, definitely a big fan of Google, particularly for YouTube. Next is Realty Income. This is another recent addition. I definitely think it's better to hold REITs in your retirement accounts, but I like Realty Income because it pays fair dividends for sure, good historical returns, good historical growth, and just that monthly payout, something that can really help your portfolio be consistent in terms of the earnings, each month. So that alone adds a lot of intrinsic value to it, I think, for other dividend share buyers and for myself. And yeah, like, and it still pays a fair enough dividend even after taxes for me to keep it in the non-retirement account. Okay, VYM. VYM has been one of my best performers. It's one of the first shares that I was buying into. Really like VYM. Similar holding SCHD. I know this one's wildly popular. And I've been buying more into this position as of late. It's one that I actually had purchased more of on Friday as well. And it's one that I want to continue buying into pretty heavily. Next is VIG, Vanguard Income Growth. I like VIG. It's pretty much the same strategy as the rest of my portfolio here. You know, companies that are growing their dividends, growing their income, growth in income. So who can argue against that? I used to hold VIGI and VYMI as well. So I used to actually back in the day hold VYM, VIGI, VIG, and VYM. Pretty much just the two shares and then the international versions. But, you know, international tends to underperform, and I'm willing to just skip it on any gains from internationals during periods where domestic may be down, just because on such a wide historical basis, which obviously the history has nothing to do with the future, but it can be a fair enough predictor for me, at least. Everybody has to make their own decisions. And I just decided I'm better off probably just not holding international. I'll find other things to grow my money in domestically. Because the USA has such a strong business sense, such a strong culture for business and growth. And I think that a lot of great things are going to come out of this period in history. SCHG, this is just because it kind of doesn't align with the rest of the portfolio, but I'm buying SCHG because I eventually plan to sell out of SCHG at some point when it may be greatly appreciated, and then there may be positions where I can convert this into high yielding stocks that are on a great discount and just lock in some great yields. So I'm optimistic to do that at some point, because obviously in theory, if you just buy growth stocks, you would typically end up better off financially. So that's why I have a little bit of that in here, just to capture that exposure, get the high growth, and then put it into some of these lower growing stocks that may pay me a higher dividend, because the point of this portfolio is to capture dividends to eventually help supplement my income. All right, so I wanted to jump into the dividend yield. So currently it looks like I'm expected to get 280, call it $287, $286 over 1135. I'll just say 287 over 1135. Keep it simple. 287, 11035. So we're at 2.6% dividend yield. Not bad. I do want to get it closer to 4%, but I'm actually happy with the 2.6%, considering I have a lot of high growth companies that quickly grow their dividends, such as Apple, such as Microsoft, Visa, I'm sure Discover, Google. And then I have also positions like SCHG, which are paying really low dividends, you know, but I plan to exchange this later on in the future. I mean, it's only a very small position in the portfolio, but if I switch this into SCHD right now, for example, that would, and see it's grown better than my SCHD position, so that would have given me, in theory, some gain there. That right there would increase my income by another, I don't know, $2 a year or something like that. But all that adds up, that would increase the percentage, maybe another 0.1%, you know, or whatever, 0.05%. All right, so anyways, that was a pretty comprehensive rerun. Really hope you guys enjoyed this video. It's just a quick video. Like I mentioned, you know, right now that if you look at the growth on my equities, it's substantially less than the growth in my ETFs, although the ETFs are much percentage of my portfolio. So I do plan to load up more on ETFs, and we'll see if over time, as I buy down in these discounted prices on shares that are down and allow time and the market to do its thing, if we're going to see a switch where the individual stocks start to outperform my ETF positions. In theory, I believe it will, because I'm buying what I consider pretty high quality companies. Maybe I will trim more companies, but the only other company I want to add is Amex. Honorable considerations would be railroad companies and maybe one or two banking companies, maybe like a Chase, but I have so much exposure through other things, I'm sure, through these ETFs. I really don't feel like getting into any of those other companies, just because I believe that these are the specific companies that are going to have really high growth potential into the future, really high quality companies that align with my investment strategies, and I don't want to hold any more, because although there's other companies that would be great to add to the portfolio, I don't believe that they would be better than these specific holdings that I already have. But who knows with time? Time always changes opinion. We'll continue learning, continue growing. If there's any specific shares that you think, stocks that you think I should look into, please go ahead and comment down below. I'd love to take that into consideration. If there's anything you think that I should consider or anything that you want me to discuss on another video, please let me know. I'll continue posting these videos to see if it's something that maybe you all like. If you do like it, go ahead, please like, comment, subscribe, so you can see these kinds of videos in the future.